A doom loop is a term used in economics and finance to describe a self-reinforcing cycle of negative events that can lead to a downward spiral in an economy or financial system. It typically involves a combination of factors that exacerbate each other, creating a vicious circle of problems that can be difficult to break. One common example of a doom loop occurs in the context of banking and sovereign debt. It starts when a country's government accumulates a high level of debt, often due to excessive borrowing to finance its spending. As the government's debt burden grows, investors and creditors become increasingly concerned about the country's ability to repay its obligations. This can lead to higher interest rates on government bonds, as investors demand higher returns to compensate for the perceived risk. Higher interest rates can have a cascading effect on the economy. They increase the cost of borrowing for both the government and private sector, making it more expensive for businesses to invest and consumers to borrow. This can lead to lower economic growth, reduced tax revenues for the government, and ultimately, even higher levels of debt relative to the size of the economy. As the economic situation worsens, the government may resort to austerity measures, such as cutting public spending and increasing taxes, to try to reduce the budget deficit and regain investor confidence. However, these measures can further depress economic activity, leading to a vicious cycle of falling revenues and a growing debt burden. This, in turn, can lead to more uncertainty and higher interest rates, perpetuating the doom loop. In some cases, the banking sector becomes entangled in this cycle. If banks hold a significant amount of government debt, the worsening economic and fiscal situation can erode the value of their assets, making them more vulnerable to financial distress. This, in turn, can undermine confidence in the banking system and lead to a withdrawal of deposits, exacerbating the crisis. Breaking the doom loop can be extremely challenging. It often requires a combination of fiscal and monetary policy measures, along with structural reforms to address the underlying issues that led to the crisis in the first place. International assistance and support from institutions like the International Monetary Fund (IMF) may also be necessary to stabilize the situation. In summary, a doom loop is a self-reinforcing cycle of negative events that can lead to a downward spiral in an economy or financial system. It typically involves a combination of factors such as high government debt, rising interest rates, economic contraction, and banking sector vulnerabilities. Breaking the doom loop requires a coordinated and comprehensive approach to restore confidence, stabilize the economy, and address the root causes of the crisis.